we're nowhere near done, I guess, is the point of this whole process with the rate hike campaign. But you're hearing a lot more these days about journey versus destination. In other words, the number or types of rate hikes that we have versus what the ending rate for Fed funds will be. Which are you paying attention to more?
Well, good morning. And I watched that interview, and she was clear to say that the Fed has entered into a restrictive zone. And I was reassured to hear that, because at least it tells us that they're monitoring how the impact of all these rate hikes is affecting the economy. So I think she even did say that we're down to a 0.5 level, and that 0.75 was quite aggressive. So you could hear that the downward slide in rate hikes is here. I think that's because they're seeing the slowdown in the economic data. Housing, rental prices, commodity prices are all starting to slow down. So I'm looking for a more benign Fed in 2023, and I think that could eventually become positive for stocks.
So Malcolm, it's a good point, that this idea that you could have certain Fed policymakers, in essence, throttling back, right, on some of their commentary. They're still hawkish, just not as much so. Is it a reason to be more constructive on stocks, this idea that, yes, we know the Fed is going to continue to hike interest rates, but they're not going to keep going at this 75 basis point clip the entire way?
Well, I think it's great to hear Fed governors coming out and, remaining hawkish, but also giving a little bit of hope. But we also know that there's really only one Fed official whose statements really matter here. And I also think, to answer your question more directly, Dom, the reality is that most investors have already tempered their expectations that 75 basis points in December is very, very, very unlikely. We're probably going to see 50 basis points. I think consensus has rallied around that. And so the majority of any activity we see in the markets that's related to Fed policy, specifically from here on out, is going to be based on whether we think there's a pivot coming or a cut coming or some positive movement in rates that way in 2023, because nobody wants to be behind that curve. Nobody wants to be late to the pivot party, is the phrasing that I heard recently. And so I think that most of the activity is baking in that 75 basis points is gone and trying to get ahead of where Powell will go for 2023.
So, Malcolm, does that mean that you're looking at tech stocks again? Is it media communication services? We've talked about at length over the last several days and then weeks now. Disney just the latest, but the underperformance in places like media and technology, are those the places that you want to be if you don't want to be, so to speak, late to that pivot party?
Yeah, Dom, I've never abandoned my beloved tech trade. I think that any market movement that we have in the near term, right, in the next 6 to 12 months, is going to be driven by mega cap tech. I think that eventually we rotate away from that trade, but I also think it's very, very tough to get away from those 8-10 names that led the initial correction. I think those names also have to lead us out of it. And we can have a recovery toward the end of this year or early next year, more likely, without those names participating. But it would be a much bigger recovery with those names participating. And so I think it's very tough to leave them behind just yet. I think that rotation that people are looking for is more of a 2023, 2024 story.
Mark, it's not just equities, right, that are part of this conversation right now. We've gone for years talking about the TINA trade. There is no alternative. You had to be in stocks because you were making nothing in yield on the bond market. All of a sudden, you're making 4.5% on short duration 2-year Treasury notes. That's what the yield is, and 3.25%, call it, to 4% for 10-year notes, and even better for investment grade corporate debt, highly rated stuff. Are bonds now a more attractive part of that story? Does that 60-40 portfolio, so to speak, come back into the lexicon here in financial markets?
Well, that's a great question. And since many investors fall into that moderate risk, lower on the growth end profile, a 60-40 allocation does make sense for them. And for people to look backwards at this past year and say a 60-40 portfolio is dead because, candidly, it's had a bad year, that's the wrong way to look at it. You have to look forward. And now that interest rates are higher, bonds could provide that buffer against when a stock market decline happens. You're getting 4.5% on a treasury, 5.5% on an investment grade corporate. And that is, while right now below the inflation level, it's well above the target that the Fed is settling on. So I think for moderate risk investors to abandon the bond trade just because it had a bad year this year is looking in the rearview mirror. And instead, they should look forward and see more of an opportunity in a balanced portfolio.
We've got just a few moments left, gentlemen. Mark, I'll start with you. In a couple of short sentences here, your favorite sector or stock and why?
Well, I'm looking at where interest rates are. We spent the day talking about interest rates and how they're higher. I think a sector like the insurance sector with a huge bond portfolio, those asset values have been beaten down. They own real estate, which has been beaten down, and they've improved their internal product lines, lower risk offerings, better management, lower costs. We like financials and we like the insurance sector.
And Malcolm, the last word to you, your favorite sector or stock out there?
Yeah, I would drill all the way down in that mega cap tech trade I mentioned and focus specifically on cloud computing. I think that sector, when we talk about quality companies that have decent financials and actually have the potential to see some positive returns when the rest of the market is depressed, to deliver their product costs very little. And the migration to cloud computing is not going to stop anytime soon, whether we're in a recession or not.